Good morning, everyone. Thanks for joining us for our usual weekly morning call. Today we have a lot of stock counter updates. A lot of results were out over the past week, and then we also have a number of technical analysis counters that Zain will run through. And as usual, we'll have the Singapore Weekly. Today we also have the Semiconductors update. So, without any further delay, let me hand over the time to John, who will start with the Semiconductors update. Yeah, thanks, John.
Thanks, Aaron, and good morning, everyone. We'll start with our semicon update for the quarter ending December 2023. We issued a report this morning titled AI Driving Most of the Early Recovery. So overall, fourth quarter results were quite good for the semiconductor industry. Revenue growth for these 10 companies here, which are proxy, your largest semicon companies, we accelerated quite significantly to 25% year-on-year. In the third quarter, this number was flat. So you can see significant re-acceleration here. Of course, most of the good results were mainly due to AI driving a lot of demand. So you can see, for processor and memory, these set of companies did, really a lot better than equipment and foundry. When you look at processors, you're looking at your CPUs and your GPUs. So most of it, I guess, will be more on your data center CPUs and data center GPUs, which will help NVIDIA as well as AMD. They're seeing still a lot of AI demand for their chips, especially because there's increasing workload capacity from end customers. So they're just kind of ordering more and more GPUs. At the same time, with the China bans, or rather the US export controls to China, a lot of the Chinese customers were actually stockpiling all of these GPUs. In terms of just your regular PC CPUs, this was also improving, and mainly because we're starting to see the PC market pick up a little bit more. And we could see this towards the end of 2023, and it should continue into 2024. Along with increasing processor capacity and performance, memory is also starting to do a lot better. So when we talk about memory, it's your high bandwidth DRAM as well as flash NAND memory. And the main reasons for this is also because of AI, because with higher compute and higher workloads, there's a significant need for more memory. And so a lot of the memory companies are also starting to see a lot of influx in demand for their products. For most of 2023, they were actually facing a significant inventory normalization. So there were a lot of their customers that had too much memory, and they weren't really ordering that much because they wanted to work through what they already had in stock. But this has kind of normalized. So we're starting to see demand come back for a lot of memory components. At the same time, when you look at prices, prices for NAND memory actually increased about 20% year-on-year in the fourth quarter. And so we should start to see a pickup in both volume and prices, which will benefit memory companies moving forward, at least in the near term. In terms of so that's for your processor and memory. Obviously, AI driving both of it. When you look at how it performed, how these stocks performed in the stock market year to date, you just take NVIDIA, for example, they're up about 70% year to date. And then when you look at the overall semicon industry, when you just look at the VanEck Semiconductor ETF, with its SMH, ticker counter SMH, it's up about 30% year to date. So when you compare it to, it's quite significant when you just compare it to the S&P 500, which is up about 8+%, and then the Nasdaq is up about 10%. It's like triple or more than triple the performance of these large indexes. So there's still significant demand for semiconductors, and significant price upside as well. Next slide, please. So moving on to equipment and foundry. For equipment, you've got ASML, Applied Materials, and Lam. All three companies actually beat their revenue expectations. But in terms of year-on-year revenue growth, or rather, Applied Materials and Lam were still actually contracting a little bit year-on-year. So even though they beat, I guess expectations weren't very high in the first place. But the positive thing is that they're coming out of a down cycle, and they're starting to see a lot of the utilization rates improve their equipment, which should point to at least a little bit more upside or a little bit of a recovery moving to 2024 and definitely into 2025. The key highlight for equipment makers was ASML, which led the way again. They ended the year with an order backlog of 39 billion euros, up slightly from 35 billion euros in the third quarter. So you're starting to see a lot of orders come in, and that's kind of what boosted their results for the quarter. In terms of commentary, most of the equipment manufacturers are quite positive on or at least the mid-term. Not so much for 2024. They expect the recovery to take at least 6 to 9 months based on guidance. They're not really guiding to that much in the first quarter, mainly due to seasonal weakness. But in general, the first half of this year, they said they still expect some sort of weakness, but for it to pick up quite significantly in the latter half and definitely in 2025. Moving on to Foundry, the biggest player here is TSMC. Earnings, or rather revenue, was quite flat. Slight contraction, but it was a significant improvement from the third quarter, when it was down 15% year on year. A lot of the demand here was supported by a ramp in their advanced technologies, which are smaller than their 7 nanometers and below. So you have 2 nanometer, 3 nanometer, and 5 nanometer. Most of these chips are basically embedded in a lot of your smartphones and your high-end data centers and high-end PCs. And this represented about 67% of total revenue. And it's growing at a much faster rate than their more mature nodes, which are your larger chips. At the same time, TSMC now expects some healthy growth in 2024, which is quite a turnaround from what they were actually previously guiding to in the third quarter, where they mentioned that they expected about 8 to 10% year-on-year contraction for this full year that we're in. Which is, I guess, is a positive for most of the industry, because these are the foundry companies. If they are seeing demand go up, it kind of trickles into everywhere else. At the same time, what they did mention that they're moving into, and this comes to it's a similar point to what the processor companies are mentioning. A lot of the edge devices, which are your AI PCs and your higher end smartphones, as they start to get rolled out more and more into mainstream use, when they incorporate a lot of these AI functionality, they require a lot of your more high performance computing chip, which are your smaller 3 nanometer and 5 nanometer. And 2 nanometers, of course. And so we think that as more and more people shift from just your regular compute to higher compute, and the devices that are coming out require more functionality, they should help to at least support long-term demand for growth in a lot of these smaller high compute chips. So overall, for the semiconductor industry, we're quite positive. Obviously, we think that it's quite clear that they are working through a down cycle. They're kind of in the early stages of recovery, which should help to benefit most of your semiconductor companies, especially as usually the cycles take about 2 or 3 years to peak. So we're just in the first few innings, and there's still quite a long way. So that's all for me. I hand it over to Ambrish for the Airbnb. Thank you. Oh, sorry.
Thank you. Thank you, John, and good morning, everyone. So moving on to Block's fourth quarter results. Next slide, please. Thank you. Block is a fintech company, and overall, the fourth quarter results were within our expectations, with full year 2023 revenue and adjusted PATMI coming in at 100% and 98% of our full year forecasts. So for the fourth quarter, total revenue for Block, it grew by about 24% year over year, and it was mainly driven by its Cash App segment. So Cash App, it's basically, it provides the investing and banking services to consumers, like it provides a savings account, debit card facility, as well as the users, they can invest into stocks and Bitcoins. So the gross profit for Cash App, it grew by about 25% year over year. And this was mainly because of the 10% surge in its monthly active users to about 56 million, and also because of high engagement. So the number of users and high engagement, we believe that this was mainly because Block, it continuously enhanced its products, as well as it also added in new features. Like most recently, it introduced like the users, they can earn an annual interest of about 4.45% on their savings balance, and also they introduced free they can get up to $50 free overdraft facilities. So because of these enhancements, the number of users grew. And secondly, Block, it's focusing on improving its bottom line. So after excluding the one-offs, the adjusted PATMI, it grew by about 113%, year over year to $285 million US. And this was mainly because of the continuous cost cutting initiatives. Like for instance, the operating expenses for this quarter, they grew by about 20% as compared to almost 45% in the fourth quarter of 2022. And this was mainly because of the initiatives like job layoffs, careful sales and marketing spend, and also real estate consolidations. So moving on to the negatives, the Square segment. So the Square segment, it basically provides payment processing solutions to merchants as well as hardwares like the credit card readers. So the Square segment, it reported 10% growth in its payment volumes, and which was like a drop of about 4% as compared to the fourth quarter of 2022. And management, it also highlighted that in the month of January, it further decelerated by about 3 to 4%. And this was mainly because of the bad weather particularly in US, and this impacted the in-person volumes for like retail and food categories. And this was across the industry and not just specific to Block. So, in terms of outlook for the full year of 2024, the gross profit is expected to grow by about 15% year over year, and it will be driven by its Cash App segment. Although it's expected to moderate, but it would be still fueled by its growing number of users as well as high inflows to the platform and increased adoption to its debit card facilities. Like for instance, like in the fourth quarter of 2023, the number of debit card users, they grew by about 20% year over year. And the management, it also increased their earnings guidance for adjusted EBITDA by about 200 million. And they now expect a $2.6 billion of adjusted EBITDA for the full year of 2024. And this was mainly because of the high operating leverage. So in terms of valuations, we have downgraded to accumulate from buy, mainly because the stock has surged over the last couple of days. And we have increased our target price to 94 from 85, mainly because we have increased full year 2024 revenue by 2% and adjusted PATMI by 11%, mainly to reflect the increased adoption of its Cash App product, and also because of the low operating expenses. And in terms of catalyst for the stock, we believe that it would be a continued margin expansion, as well as the Block's ability to be as a substitute to traditional banking solutions, particularly for the millions of customers who fall under the lower income or underbanked demographics. So that's all for me. I would now like to pass it on to Glenn for OCBC.
Hey, thanks, Ambrish. Yep. So for OCBC, they released their fourth quarter and full year FY23 results last week. Let's jump straight to the next slide. Yep. So their fourth quarter earnings of 1.62 billion met our estimates, and it's most like came from the higher fee income as well as stable net interest income. And the FY23 earnings was at 100% of our forecast. So for their dividends, their fourth quarter dividends was up 5% year on year to 42 cents. And their full year dividend rose 21% year on year to 82 cents. So the dividend payout ratio has been is stable at around 53%. So this came in slightly below our expectations. We were sort of expecting them to sort of release some of their capital and to pay slightly higher dividends this year. Anyway, just jumping straight to the positives. First positive being that their net interest income grew 3% year on year. So their growth was led by a 4% increase in their average assets. And this was offset by their net interest margins moderating 2 basis points year on year to 2.29%. And loans growth also was relatively flat. It only grew about 1%. And the NIM moderation was mainly from higher funding costs, which offset the increase in asset yields. For their fee income, it also continued to grow, and this is what mainly drove the growth in the fourth quarter, and it rose 15% year on year. So this was due to broad-based growth in their wealth management fees from increased customer activities as well as higher credit card fees and loan and trade-related fees. So their FY23 full year wealth management income, it grew by 26% year on year, and it contributed to 32% of the group's total income. So this is an increase from the 30% the previous year in FY22. Now, for the third positive is that their total allowances fell 40% year-on-year, as there was a decline in both their specific provisions as well as their general provisions. So this resulted in the total credit cost improving by 14 basis points year-on-year to 21 basis points. Their full year credit costs were higher at 20 basis points, but still came in within their guidance. It's only marginally higher from the 16 basis points the previous year. So for the negatives, first negative is that their insurance income was down 12% year-on-year, and this was driven mainly by higher claims in Singapore and Malaysia, which were partially offset by higher contributions from their Singapore life business. So for the second negative, their expenses also rose. It rose 19% year-on-year, mainly from higher staff costs and other operating expenses. So the rise in staff costs was the usual annual salary adjustments, headcount growth, as well as they also gave a one-off support to help their junior employees. And this resulted in their fourth quarter cost-to-income ratio rising by 3.7 percentage points to 40%. But if you look at their full year cost-to-income ratio, it actually improved by 4.2 percentage points to 38.7%, as the rise in income outpaced the rise in expenses. For the third negative is that their current account savings accounts ratio fell by 3.1 percentage points year-on-year to 48.7% due to the continued high interest rate environment and this continued move towards fixed deposits. But their total customer deposits did grow by 4% year-on-year. Now for the outlook, they have guided, OCBC has guided for loans growth for FY24 at a low single digit, and they have mentioned that this will be coming from segments such as the energy and power utility segments and what they call inflation-resistant segments such as purpose-built student accommodation and hospitality, as well as the technology and digital infrastructure. So for the markets they are looking to see this growth from, it will be from core markets they have such as Singapore, Indonesia, Hong Kong, and Greater China. But for Greater China, they're looking more at offshore instead of onshore growth. Also for the fee income, they have guided for fee income growth of around 12%. We are expecting fee income growth of 12% for FY24, and this will mainly come from their wealth management arm. So they also had this recent acquisition of the PT Bank Commonwealth in Indonesia, and this will help to accelerate their growth in ASEAN. As such, we maintain a buy with an unchanged target price of $14.96, and we do lower the FY24 earnings by 6%, mainly as we lower the net interest income estimates from softer net interest margins and increase allowance estimates, which are offset by the higher fee income as well as other non-interest income. So we do expect the FY24 earnings will grow from the low double-digit fee income recovery as well as stabilized provisions. And we expect that the net interest income will remain flat as stable loan growth from rate cuts expected in the second half of FY24 will be offset by the moderating NIMs. We do like OCBC due to attractive valuations and a forecasted dividend yield of 6.7%, buffered by a well-capitalized 15.9% CET1 and non-interest income growth from their recent acquisitions in the insurance segment as well as the acquisition they did in Indonesia. So that's all I have for OCBC. I'll now hand it over to Darren. Thank you.
Yeah, thanks, Glenn. So CLI released their results last week. So for their results, the PATMI was basically under our estimates, mainly because of this 600 million fair value loss. But if you strip that out, it was just slightly under our estimates, at about 8% below our estimates, if we strip out these 600 million fair value losses. So for the positives for this set of results, the full year 23, the fee-related business revenue, it grew by 8.7%. So year-on-year. So this was mainly because of the improvement in lodging management and commercial management, as well as the increase in the recurring fund management fees. So this recurring fund management fees includes both under the listed fund management as well as the PE, the private side of the fund management. So this recurring fund management fees grew 9.3% year-on-year, and event-driven fees, it fell 52% year-on-year, mainly because of the absence of transactions. So basically for these event-driven fees, we think it will likely pick up as interest rates has relatively stabilized already. So for the negatives, the real estate investment business, the revenue for full year 23, it fell by 8.5%, mainly because of lower corporate leasing income from the USA, as well as lower rental revenue from properties in China. So we noted that the rental reversions were negative across all assets in China. So previously in China, the new economy segment or subsector was the only asset class that managed to generate some positive rental reversions. But we saw in this most recent FY, all rental reversions were negative. So of course, the biggest hit for their this year's results were the significant fair value losses of 600 million. So this was due to a weaker outlook in China. So for China, the fair value losses was 500 million. And in USA, because of cap rate expansion, we saw the valuations drop by 231 million. So this was partially offset by stronger valuations in Singapore and India. Yeah. So for the outlook, CLI right now their funds under management is 100 billion. So this 100 billion it includes 10 billion in undeployed funds. So it's ready to be deployed, but it's currently undeployed. So it's committed capital already. So if you include that, the total FUM now is 100 billion. So their new target is to reach 200 billion in 5 years. So they plan to do this by inorganic as well as organic growth. So they are considering some M&A deals as well if it's possible. So for them next, the event-driven fee-related income, like I mentioned, is expected to pick up as interest rate stabilizes, and the pace of divestments is also expected to pick up. So in the full year 23, their assets divested was 2.1 billion. So this was shy of its 3 billion target. So right now it currently has 9 billion of assets in the divestment pipeline, and most of it is from China. So the management, they indicated that their key priority or key focus for FY24 is that they are looking to divest, lighten their balance sheet in China and USA especially. Yeah. Another thing to note is that in the second half of 23, there were also a notable uptick in transactions. So as you can see in the portfolio gain section in the chart on the left, yeah, there was a 52% rise in transactions year on year. Yeah, so with that, we maintain our buy call, but we lower our sum of the parts target price to $3.38. So we lower our PATMI estimates by about 15% to account for a lower China revenue, lower China contribution, as well as our RNAV were affected by the valuation losses. Yeah, so one more thing to note is that the CLI, they declared a dividend of 12 cents. So that is about 4.4% dividend yield. Yeah, so that's all for me. I'll hand over time to Sheng. Talk about technicals.
Thanks, Aaron. I'll move on to the technicals. Next slide, please. Yeah, so for S&P 500, we saw another close at an all-time high. Currently, the index is trading in this short-term uptrend channel highlighted in bold in the chart. So as we are quite near the channel resistance in the near term, we are likely to see some consolidation ahead this week. Immediate resistance will be at 5,160 points to about 5,200 points. Immediate support will likely be at 5,060 points to about 5,095 points. Next slide, please. So the next one will be on ETF money for February. So just a review of performance last month. Most of the ETFs actually posted quite good gains, about 5% or more. Less Singapore equities, which was quite flat, and US Treasury bonds, which was down about a modest 2%. In terms of their current trends wise, most of them are in the range consolidation, while S&P 500 and Bitcoin are currently leading in an uptrend. Then in terms of our outlook for this month, we expect we are more upbeat about the prospects of gold, oil, and Hang Seng Index, which we are likely to continue their bullish momentum into this month, while the remaining asset classes are likely to trend sideways in March. Next slide, please. Yeah, so to dive in on the respective ETFs, I'll start off with the VOO, which actually tracks the S&P 500. We are currently seeing that it's trading outside the mean uptrend channel, so that signifies very strong momentum as reflected in the MACD. Currently, it's also trading in this short-term uptrend channel, but I will expect some sideways movement in the month ahead, as we are currently quite at an overbought level, as well as we are seeing the price trade at a near-term uptrend channel resistance as well. Yeah, so this is for the VOO. Next slide, please. So next one is on the Treasury Bond ETF, IEF. So for this, in February, we saw that price action has been quite muted. It's basically trading in the range. So also showing decreasing momentum on MACD as well. So for this month, we are likely to see this range actually continue with upside bias to actually retest the $96 near-term resistance level. So we are likely to see some continued range-bound trading with a bit of a bounce in March. Next slide. Okay, the next one is on gold. This SPDR Gold Mini Shares Trust GLDM. So for gold, it looks interesting as actually it has consolidated in this bullish flag, highlighted in bold for quite a long period since about November of last year, and actually it achieved quite a strong close the last week of February as well. So we are likely to see we could see gold actually extend its bullish momentum, break out of this bullish flag previously as it was trading in an uptrend channel. And the expected move is about $2, which translates about 5% gain in the coming month if it actually breaks out of this. Yeah, so I think gold is an interesting prospect to actually continue its bullish momentum this month. Next slide, please. The next one is on the oil and gas exploration production ETF XOP. So for oil, actually it showed some positive signs, breaking out of the downtrend channel in February. So we are likely to see it trend higher this month to actually retest some resistance close to the 150 region over there. Yeah, especially we are seeing increasing momentum in the MEC as well with a positive fresh bullish crossover in these ETF. Next slide. Okay, so for the next one will be the Bitcoin strategy ETF. So this ETF has been actually led the gains in the past month, surging about 45%. Yeah, so for this, it's currently retesting the trendline resistance again. So for this month, we could see some sideways consolidation first. There's some near-term resistance ahead, $29 to about $30 level. So we could see some consolidation ahead. But overall, it still remains in a very strong uptrend with a bullish bias to actually trend higher. Next slide. And the next one is on the Singapore equities ETF. So for Singapore equities, it largely remained range bound in February. We're seeing that the 330 level continues. Sorry, the 322 level continue acts as a resistance level, which was a swing highs in January. So but we are likely to see that the index should be able to find support at the 310 level, which was the near-term swing low, as well as the main uptrend channel. So that will lead to the index actually trading in a bit of a range bound going into March. Next slide. Then last but not least will be the Hang Seng Index ETF. So for this, actually looks a bit similar to the oil ETF just now. There was a breakout above the downtrend channel in February after a double bottom close to the $50 level. So some positive signs. We expect the Hang Seng ETF to actually trend higher in March to actually retest above the $60 to $65 levels. Also, we are seeing a fresh bullish crossover in MECD as well. Yeah. Next slide, please. Okay, so the next one is on the Thai SDRs. So for Thai SDRs, all three of them showed good price recovery in February, gaining about 4 to 10%. The top gainer was CPO. And for the current trends wise, currently still in a bit of a range consolidation. So in terms of the outlook for March, we are likely to see either sideways or downwards movement. So sideways for Airports of Thailand as well as CPO, as they are likely to consolidate their recent price gains with near-term resistance ahead. As for PTT, we are likely to see the price pull back further in the bearish flag with a bearish bias to break down of it. Yeah. Next slide. So first one is the Airports of Thailand. For Airports of Thailand, we are seeing some positive signs is that showing some bullish signals is inching up with a higher high and higher low slowly. However, it's approaching the key resistance which is around 65 to 67 baht level. 65.50 baht, which was the prior support breakdown level, will act as a bit of resistance. We're also seeing there's also a downtrend resistance line near term ahead. So we are likely to see some consolidation in the coming month. Yeah. Next slide. Okay, the next one is on CPO. For CPO, what we saw in February was actually a double bottom So it actually broke out of a double bottom, clearing above the 56 neckline resistance. So actually we tested about 58 to 59 baht, which was the previous support level breakdown, and seeing some short-term resistance over there. So similar to Aviation of Thailand, we also have a downtrend resistance line ahead. So that will actually contribute the share price actually likely to consolidate sideways in March. Yeah. Next slide. Then the last one will be on PTT. So PTT is the weakest of all three of them. What it did in February was actually continue to grind in this bearish flag over here. But what it essentially did was a retest of the previous uptrend support line and finding some resistance at the 150 baht level. So we are likely to see PTT actually just continue to just be kept in this bearish flag with a bearish bias to actually break down of it in March, given that overall is showing some bearish momentum in both MACD and RSI. Also the price action with a retest of the broken uptrend support line. Next slide. So that's all for the monthlies. I'll move on to the technical calls. The first one is a technical buy for Yangzijiang Shipbuilding at 174, take profit level at 185 and stop loss at 168. The stop loss goes at 179 on Friday. So looking at the chart for Yangzijiang, after the earnings release, there was a breakout of this bullish pattern with high volume. Also, before this consolidation, it was actually trading in an uptrend channel. So the prevailing trend is a bullish one. So with this breakout, we're likely to see it extend its bullish trend towards the 185 level. When we take the height of the consolidation pattern, which is about 15 cents, and project onto a breakout point at 170. The bullish move is also supported with a strong bullish crossover, fresh bullish crossover in the MACD as well. Next slide. So the next technical call is a technical buy for ARM at $141.04. Take profit level 164 and a stop loss at 131. The stop loss goes at $141.62 on Friday. So for ARM, what we are seeing is that the stock actually found support upon retest of a range consolidation breakout highlighted in blue. So the range was between about $117 to $136, and there was a breakout and did a retest along the confluence of an uptrend support line as well, highlighted in black. So with that, we are likely to see the price actually rebound, continue its bullish momentum towards a retest of the 164 swing high level, supported with strong momentum at MACD as well. Next slide. Yeah, so this is just a summary of the trades initiated mentioned just now. Both are in progress. Yangzijiang is up about over 2% and ARM is up about 0.4%. So that's all from me now. I'll hand over time to Peggy to discuss about her slides. Thanks.
Thank you, Zane. Morning. Talk about ST Engineering results for the year FY23. Can I? Next page, please. Thanks. Yeah. The results were in line with our forecast for 23. If you exclude one-off items, the net profit was really up 23.7%. The biggest growth segment, in fact, came from the aerospace. The revenue, the growth would be 47% on the EBIT level. If we exclude the one-off restructuring gain that they enjoyed in FY22, this segment enjoyed a strong aerospace MRO demand, and the passenger to freighter conversion, they have already scaled the learning curve and starting to turn profitable. However, the segment margin is down 1.5 percentage point to 8.6%. As with other businesses in the aviation sector, they face with higher manpower costs and labor crunch. The largest segment for the group is still defense and public security. That EBIT is also up 40%, largely because they no longer need to recognize any losses from the divested US Marine business, which was sold in FY22. The key growth segment in this, under this, the sub-segment in this under defense and public security is the digital systems and cyber. This is now 39% of revenue. compared with 35% in FY22. It's now the biggest segment of the group. So the EBIT margin for this segment continues to improve by 3.8 percentage point to 13.3% due to a better product mix. We believe the digital systems and cyber, which is really more about tech and AI and cloud capabilities, is a higher margin segment business. The third positive is net debt, which is slightly lower to 5.8 billion, but the net debt to EBITDA has actually improved to 4.2 times from FY22's of 5 times. Now, management reiterated that reducing debt is still their focus. The dividend is expected to be maintained at 16 cents for full year. The negative front, they incurred a 24 million restructuring loss and divestment loss at the Urban Solutions and Satcom business. That's explained the 66% decline in EBIT. But this business actually had a bigger gain in the second half. And going forward, Transcore, which contributed positively from fourth quarter 23, is expected to become a significant contributor in this segment. Therefore, the growth in USS is likely to be up again in FY24. For the outlook, earnings will be driven by three levers: defense spending and stockpiling. This is very evident with the geopolitical tensions. All countries are talking about stockpiling and raising defense spending. And second is a greater deployment of digital services, critical command and controls, and cyber. Even within the Singapore market, more budget has been allocated for this in this area. And of course, the third one is the Transcore begin to contribute positively from FY24. We maintain our FY24 earnings forecast, but we downgrade our call to accumulate because of the recent share price appreciation, and maintain our target price, which is derived from DCF at $4.50. Thank you. Next slide, please. Thanks. I talk about China Aviation Oil. Also, 23 results were announced last week. The net profit actually surpassed our expectations by 22% because the 33% owned associates, Shanghai Pudong International Airport refueling facilities, had a stronger than expected gains. The positive is that they have grown their gross profit per metric ton. That jumped to $2.53 per ton compared to $1.75 in FY22. The second half 23 was even more impressive at about $3.78. So going forward, I think this higher gross margin is likely to be able to sustain. So our forecast is about 350 for going forward into 24. And contributions from the associates has improved, mainly driven by SPIA, that the contribution rose 61% to $31 million. They also see a fivefold jump in interest income with their big, strong net cash position of 373 million at the end of the year. They translate about 65 cents Singapore cents per share. And the negative is that they provided 12 million for impairment of goodwill and investment in an associate. We think this is more like to take advantage of a good year to do some impairment. That this is not non-cash in nature. For the outlook, volume has continued to rise for them, and also for the entire China aviation sector, as the China international flights are still just 37% below the pre-COVID. It's still 37% below the pre-COVID level. And China has continued to restore bilateral flights, which were cut during the pandemic. So just recently, we see them raising the weekly flights from 35 to 50 for China to US, and that means about 100 round trips flights for this on these routes. And this is the 50 50 weekly flights is only about 1/3 of what was before pre-pandemic of 150. So there's still a lot of room for them to move up. The increased flights volume to US will benefit CAO as well. In their US refueling facility, they have 2 in the US. Okay, the net profit estimates we have to raise it by 70% to take account of the higher margin. We also roll forward our target price, which is based on discounted cash flow, and that comes out to $1.05 for China Aviation Oil. And so we maintain a buy recommendation. Thank you. Next slide, please. SATS. Okay, SATS had a third quarter business update. Some final details were not disclosed. So these are the broad numbers we pulled from the results. The positive is they continue to improve our net profit in third quarter, and it's up 45% quarter on quarter over second quarter, mainly because of the travel recovery and third quarter being a seasonally strong quarter, both for aviation as well as for cargo. So it benefited both SATS and WFS. And the associates level, we also see higher contributions coming from India for food and gateway, then from Hong Kong and Frankfurt for gateway business. As these countries are open up at a slower pace compared to Singapore. So we see still recovery, especially in Hong Kong. And flights handled for the SATS business is already at 86% of pre-pandemic level. The other services such as cargo handling, meal serve, and passengers handled are all now ranging between 94 to 99% of pre-pandemic level. So we can almost say that they have fully recovered. Okay. On the negative front, the third quarter margins, EBIT margins, 8.8% is half of what they achieved in pre-pandemic. Pre-pandemic, they did about 17% or even higher. Okay. And that's because we felt it's because of the inclusion of WFS that drove up the staff costs by 241% in the 9-month 2024. And staff costs now account for 60% of the total expenditure for the group. The net debt is flat at 2.2 billion. The SATS has been very consciously trying to refinance the debt which they inherited from WFS, as well as the debt that they incurred for acquiring WFS. So they've been trying move down the interest cost from 7% down to the latest refinancing effort. They managed to secure a loan at 3.5%. So overall, for the FY24, we think it will end up at a level of 4% or slightly above 4%. One thing to note is they still have about euro 580 million to be refinanced. That it will mature in May 2024. So that's about 847 million Sing dollar. The third quarter, if we use just third quarter profit to annualize, the ROE is 5.4%. It's been dragged down by WFS as well. If you look at the revenue split in the table, SATS contributed 28 million net profit in third quarter, WFS 3 million, same as what they did in second quarter. So net margin wise, SATS is the one contributing 4.8%, or WFS net margin is 0.4%. So going forward, revenue growth slightly to slow. We still expect some improvement in Q&Q in revenue for fourth quarter. As we see, ship costs are rising. They also service the maritime sector, the cruise liners. But aviation demands appears to have they'll be peaking. And net profit growth going forward is going to be driven by the associates as they open up, especially from Japan and maybe Hong Kong, China, and India. And hopefully they manage to reduce the cost of debt and therefore reduce the interest cost. If you look at the table on the right, there's a wider jaw between EBIT and net profit from second quarter 24 to third quarter 24. So we suspect that is because of increase in interest expense in the third quarter. So they're working on both refinancing their debt as well as to manage their costs down. Thank you. So for this we are maintaining our reduced call. We roll forward our target price to a new year for 12 months projected target price of $2.31. Thank you. That's all for me. I pass on to Paul. Thank you.
Yeah, thanks, Peggy. Next slide. So we'll go through Raffles Medical. They released their second half results. It's going to be lackluster, I think, for this year earnings. Next slide. So the results was below expectations. I think first half, third quarter also disappointed. So this quarter also disappointed, but it was like 90% of our forecast. The positives, not many positives to find, but if you had to find one, it's probably the China part. So if you look at the China business, they have two hospitals, one in Shanghai, one in Chongqing. If you look at the very bottom, you can see that there's a 20% revenue growth, but it still remains very small, but at least it's growing. But do note that they will still need to take 2 to 3 years to break even at the EBITDA line. So it's still going to be loss-making for them for the next 2 to 3 years. This is the first real year of opening post the pandemic. So in terms of the negatives, it's basically the revenue was the main negative. So just to recap, they are facing revenue weakness from, of course, the absence of pandemic service. So they don't have the vaccination, they don't have the testing, which is a high margin business for them. Secondly, they don't have the TCF, because this is not TCM. So this is TCF, it stands for Transitional Care Facility. So basically, these are the temporary hospitals that the authorities have been issuing out so that a patient that is discharged from the government hospital, that maybe after surgery, they just need some care before they go back home, but maybe the home's not ready and so forth. So this is like temporary care. But the problem with the TCF is that the margins have collapsed. And so it used to be, if you speak to some competitors, it used to be $600 per night, then collapsed to $200 per night. So this is what the amount the government's going to pay them. So because of heavy competition and without the high margin pandemic, so that also affected them. And that was a big growth driver for them, last year or the year before. The other very unusual thing for them is, do note that Raffles has an insurance business. It wasn't very prominent because the accounting standard didn't require them to recognize revenue. But you look on the left, the revenue is almost like 150 million from premiums and so forth. But they also suffered losses in insurance. So they suffered loss because when the pandemic lifted, then a lot of claims started to happen because everybody started to do their knee replacement. What I mean is basically they started to do their electives because during the pandemic, nobody dared to go and do a surgery. But when that happened, then you get more claims. So that turned them into a loss situation for the insurance. So for that, we cut our 2024 earnings by 30%, still neutral. But we do see a lot of weakness. I think the other weakness that they mentioned, which was a bit surprise to me, was foreign patients. So one of the recoveries we were looking forward to was foreign patients, but that ain't happening. So foreign patients at best is going to be flat. So what has happened is that, of course, apart from the strong Sing dollar, that is affecting the attractiveness of foreign patients. The other thing happening is that when the pandemic happened, a lot of foreign patients started to use local services. And I guess they're beginning to be more comfortable with that. And the third thing is there are also competition from Malaysia. A lot of Indonesians go to Malaysia. There's also Thailand. So all the Vietnamese also start to go to Thailand. So all this is pressing down, and that may no longer be a growth driver for them. The one thing that could improve for them is maybe progressively they will increase prices in Singapore and of course the narrowing losses in China. So how we are modeling this thing, modeling Raffles, is that we think it could go back to their earnings pre-pandemic, which was about the 60 to 70 million range, because we do not know any reason why they should grow above it. So that's why our numbers are coming closer to that compared to the pre-pandemic where they were running almost 200 million of profits or 100 plus. Next slide. So move on to ComfortDelGro. So ComfortDelGro, we think there's more growth ahead after these results. Next slide. So ComfortDelGro beat our expectations. Finally for once, or maybe for the second time after disappointing for how many quarters. But the positive was surprisingly for us, the positive was 3 to 4-fold jump in China earnings. So you look at the table on the left, you can see China profit jump from 2 to 8 million. So what is happening is that the model in China is like their old current taxi model. So anyone who wants to offer a ride-hail service, so even if you want to go into their Grab equivalent, you need to take a taxi license. You need to take a license for them. So they generate very good income from just renting out taxis. And you know, this business is all very high operating leverage. So when the pandemic when the pandemic was removed, restrictions were removed, they also removed the rebates, then you get this huge operating leverage for them. So that's why you can see this big jump in the China earnings. The negative continues to be the Singapore rail business. We think it's barely profitable. Our own estimate, we think Singapore rail for them is maybe making only 1 to 2 million, which is quite pathetic. I mean, considering you're running so many MRT lines. So what is the problem troubling this business is that they have to take up all the costs upfront, the surge in electricity, surge in manpower, they have to take it up before you get higher rail charges. So every year end, the authorities will raise the fare. Some of it pass to people like us, but some of it the government will give up as grants so there's a lag effect of that. So that's why we think in 2024, as electricity costs start to come down, then we think the margins will start to normalize. So we raised our forecast by 24, our target price too. So we think as you move into 2024, some of the growth drivers for them is that in June they introduced platform fees. So if you sit on the Zig app now, they will get an additional platform charge of 70 cents, which goes to them. And they also raised the commissions from 5 to 7. Yeah, even 5 to 7 is still pretty low because if you look at Grab, they charge commissions almost 20 to 30%. Commissions on the right, so you take a $10, they will charge you $2. I mean, I do not know what they do, but anyway, they charge you that. The second thing that will benefit them is the UK. So if you look at the table on the left, UK was loss-making, then there's a big turnaround. You will look at that, the swing is almost like 20 million. So what happened was that because they had to take up again the same model, they have to take up all the higher, because there's a bus shortage, so they had to take out all the costs. Then they will get repricing of the of what the authorities pay them because of inflation. So they will still get that, but the bigger jump is this thing called recontracting. So competition has come to kind of normalize after losing money. So they are getting better margins if they recontract. I mean, these are contracts that they sign with the authorities every 5 years. So every route is different. So it will take time, but this will be another growth driver for them. The third thing is, of course, taxi fleet size increasing in China, which they think they are planning to do. And the fourth, like we mentioned earlier, just margin recovery. So there's a few growth drivers. So we think 2024 will be another year of growth for Comfort. Next slide. So PropNex, I think it's challenging in 2024, but I think it's kind of bottomed out. We'll explain why. So PropNex is still the largest real estate agency. The results were below. I think first half also below. This half, second half also below. So they're like 75% of our forecast. So the positive is the market share gain. So their market share is still creeping up 1-2%. So in totality right now for PropNex, I mean, if you want to know, their market share is 62% for HDB resale and any private residential transaction, be it new and resale. So for every 3 transactions, 2 actually comes from PropNex. I mean, roughly. So that is a positive, and they still have like 12,000 agents. And the other positive was that the rising cash pile. So they generated almost 50 million of earnings. We'll explain why that's important later. Then the negative is just the weakness. As if you look at the table on the left, project marketing is down 36%. So that's mainly the new launch revenue. So our recommendation, we actually lower our earnings and we just lowered our forecast because we think there's a rebound this year for sure, but it's just that it may not be as strong until we see better take-up rates from the new launches. But they're still paying a 7%, almost 7% dividend yield. And it's very well backed by the cash. So to pay 7%, they need to pay dividends of 44 million. They generate almost 50 million of cash, so more than enough to cover. And they have an additional standby of 150 million if they need to top up dividend. And you can see they do top up. I mean, the payout ratio is officially more than 50, but I think this year they pay 90. And I won't be surprised if they're willing to pay even more than 100% payout ratio because they want to keep an attractive yield for their stock. In terms of the outlook for 24 new launches, it's a mixture. I think the positive for new launch this year is that there's going to be a recovery because post cooling measure, since the April cooling measure, then usually there's a lull period. Then after that, the second thing is there's going to be a higher number of launches. So this year, last year was 7,000. This year going to be about 11,000 new launch. Okay, doesn't mean it's going to be good for developers, but it's going to be good for them because there's new properties to sell. There's going to be a surge in completions. This year and last year, there's going to be almost 30,000 of new units completed. Okay, this is going to be good for resale, but may not be good for new launch because people may rather buy new launch. Of course, the other thing is resilient HDB prices. We continue to see more and more $1 million flats, which may not be good, but it's going to be good for upgraders. And of course, interest rates are also coming down. So the banks, they mentioned, is also lowering interest rates from 4 to 3%. Of course, these are the so-called teaser rates. Yeah, next slide. Okay, this is just a table, a bit complex table, but let me just explain. So, the first row is private. So this is the private new homes. It was down. The volume of units was down 9.6. So PropNex is expecting a jump 9 to 17. Agency X is of course the other listed company, which I think it's obviously Apex Realty. So they are looking at 4 to 6%. I'm looking at 11% because mine is not units, mine is revenue, so plus the price increase. So that's how you read this thing. So in general, it's quite sluggish. So we are expecting HDB resale 4%, rental volumes 3%. The bottom is their price. So they are expecting property price to jump 3 to 4 for PropNex. The other agency, my guess, I think this is not a forecast, more like 99% guess is 5%. Don't ask me how I get 9%. Like I say, it's a guess, right? But that's a new launch. Why we see things at bottom is that the number of transactions 2023 was about 6,004. But the trough tends to be around 7,000. So if you look at post TDSR, the volume transacted new launch is about 7,000 to 8,000. So we think this is like so-called underlying demand for new property. So that's why we think new home sales is probably trough because even after TDSR, you got the volume still hover around 7,000. So we think there's the other thing is private resale. The problem new launch. Okay, I think I won't run through all this. So the upgrading market is still attractive because there's attractive grants. Yeah, next slide. You can read the report. I mean, if you want, there's more details there. So for Siong, the problem for us is just the lack of new stores. So there were, I think for the second half, I think the whole year there's only 2 new stores. So the results are within expectation. The positive is really the continued climb in the margins, gross margins. So if you look on the left here, the gross margin for Siong is up 1.1%. And if you take over the last 10 years, so 10 years ago, their gross margins was 23, and then now it's 30%. So what they managed to do is they grow more fresh, and then now they're growing more house brands. So they've done an incredible job of growing the margins. And of course, there's also a distribution center. The negative is that there's just no new stores. So to give you an idea why this is important, over the last 3 years combined, they grew stores maybe 2 to 3% a year, cumulative 8%, whereas pre-pandemic, they were growing like double, triple, like 7 to 8%. So without that, we just worry the growth is going to be weak. And investors are going to pay like 18 times PE for something that isn't going to grow strong for at least the next 1 year. So that's why we're just worried. That's why we cut down our target price. Same store sales, that means those matured stores, like how much sales they grow. It should improve because there's less traveling. So traveling does affect people going to grocery stores. I think affect retail sales in the whole of Singapore. There's more home cooking because of inflationary pressures. The rollout of CDC does help because CDC is not available to wet markets, and neither is it available to all those very small stores selling groceries. So then the demand will skew towards them. So that it does help in the market share perspective. They are still trading at 27%. The yield is not that attractive, but they are still trading at a net cash of 324 million. Yeah, next slide. Yeah, okay, so let's go through our weekly. There's quite a lot here, but let me just mention the key one. So RevPAR, is the most important for hotels. It's like revenue for hotels in Singapore. So after 3 months of decline, you started to see a big jump in January, about 13%. So it should do better. I saw some questions on Taylor Swift. I think Darren will answer that. The big news in the US is the inflation. It's down, but a bit month on month is still quite big jump. But again, January always affected. There's a bit of sluggishness coming into the US manufacturing. So we're not sure if this is the early signs of a slowdown in the US, but this is the first indicator. So we need to see the subsequent ones. Yeah, next slide. So in terms of our tactical views, I think why we titled it REITs versus Semiconductor, because REITs were down 5% in February. I think for the year to date, they're down almost 11%. So what has happened, at least for February, is that inflation expectations has spiked up. So inflation expectations now is just that 1 month alone, we have a chart later, it climbed up 50 basis points. So that means they are cutting back on the number of rate cuts. So that actually affected REITs, because they're very interest rate sensitive. Whereas in February, the semiconductors, like John mentioned, rallied almost 11%. And they even dragged up the Singapore semiconductor. But we do expect a bit of near-term weakness for Singapore semis, because I will talk about all three of them later, but because most of them are guiding a bit of softness in first quarter. But still positive for them, because what their Singapore semiconductor, especially UMS and Franken, is that there's a big outsourcing coming to Southeast Asia. Everyone is coming out from China. Some are moving out from Europe, and some moving out to US and coming to Malaysia and Singapore. So this big trend is still underway. You don't see the volume now because it will take time, because like John mentioned, initial phase is that the prices will recover, volume recover in memory before they start ordering more capex. So it's a bit more back end loaded for equipment makers like all those in Singapore. I won't run through this, since I talked about it anyway. But in terms of the event, so you're going to hear a lot of Powell's speech. So he has 2 speeches on Wednesday and Thursday. And then we got the big one is a payrolls in the US on Friday. Tomorrow we have a Daiwa read webinar. If you want to know more what's happening in Japan, feel free to sign up. It's open to anyone. Next slide. Okay, so this is just to show you the big jump in the red line was in January. So this is where investors were expecting. So it's a bit small, but in December, they thought the Fed funds rate will be 3.8% from the current 5.25. But then they spiked it up by almost 50 basis points. Now they think the rate cuts will be around 3 cuts. The market is still expecting around 3 cuts. You can look at the table in the middle. So they're expecting second quarter 1 cut, third quarter 1 cut, and fourth quarter 1 cut at 33 basis points. But it's mainly because inflation is not coming as fast, and then the Fed also guiding everyone that is built back on loaded. So that's why REITs are taking a hit, because people don't think rate cuts won't be as many rate cuts. This line is a bit worrying, because if inflation, the rate line, we are just extrapolating. So it seems to be troughing, not coming close to their rate line 2% target. But again, January is always a bit unusual. There's a lot of seasonality. So we need to look at the February numbers. Next slide. Okay, we'll run through our usual model portfolio update. We'll do a monthly strategy report, probably out on Wednesday. Yeah. But you can see that here the property names still hurting and REITs. So FCT hurt the portfolio, likewise for CapitaLand Investments. And also Valuetronics. The one that did well is, I think, China Aviation. And also Keppel. Next slide. And ST Engineering did well also. For the sectors, what has done well is actually, you see this electronics. So this is the best performing sector. REITs also got, I think every type of REITs is all down 5%. You can see hospitality, industrial. The one on the right here is just a snapshot of the big gainers and losers. At the bottom is the index ones. So you can see the top gainers are mainly a lot of the electronics like Franken, Estee, I don't know why UMS, Value Max, but I know UMS is, of course, is so up. Surprisingly, a lot of the Hong Kong names were up, mainly because Hong Kong actually had a big rally in February. The Hong Kong market up like 6%. So all these like Hong Kong Land, DFI, Jardine all went up too. And Paradise is going to get kicked out, I mean. Next slide for the index. Okay, this is just a reflection. Again, the US continues to be the big winner, especially the Nasdaq. I mean, of course, driven by semiconductors. Again, this is just for, and REITs is the one that's suffering. Likewise, for all the bond ETFs, they're down, especially in February. Next slide. Okay, so I'll just run through the 3 semiconductor names that released the results on the analyst briefing. So, so of course, we have AEM first. The revenue, so they did the adjustment. You look under the third bullet point, inventory. I just quote what they say. Human error in inventory shortfall of 21 million in the ERPs. You can read it. So basically, somebody made a big error, I guess. But I think the more worrying is that the guidance from them. So they're only guiding for first half. So AEM is one of the very few that actually give revenue guidance. So you look at the table on the left, the bottom. So the guidance, if you analyze their first half guidance, is looking at the 18 to 30% drop. And even more worrying was that they're only going to give first half guidance because they said they can't see visibility. So let me go to the new customer. So that's the first concern that people have. The second concern is the new customers. So they mentioned they got 5 and they could actually ramp to triple digit. But I think because they've been talking about new customers the last 2 years, so investors are a bit skeptical. Yeah. And because they also worry some of the competitors are also catching up. The other thing is the guidance. So I think we mentioned the guidance, and they said that they're surprised if they get visibility. The third worry that the market have, very justified or not, is that just that the accounts not been audited. So there's a bit of worry whether could they get qualified and so forth. But again, I'm not so worried about that, but I think the market is just getting a bit worried. So these are the 3 concerns they have. I mean, it's the weak guidance, whether they can actually get new customers, and also the third one is still yet to get an audit. Yeah. Next slide. The next one is UMS briefing. So for UMS, the earnings was down 11%. But what they did say is it was better than expected. But what they did say is that the major customers actually pull in the orders. So because they are in AEM, because some of their major customers like Applied Materials, they because of tiered pricing. So what we mean by tiered pricing is that if you order more, you get better discounts. So that's why fourth quarter they saw a lot of demand coming up from from Applied Materials because of the tiered pricing. They also mentioned that the Penang plant is being completed. So that was the main highlight. Penang plant is being completed. And then they are starting to get orders in March, and then they should see a progressive ramp up. So this is the main talking point for them, that they're going to get these big major customers. And they also did a placement to raise 51 million to fund the nearby land. But I do note that they are highlighting that maybe the next 1-2 months might be a bit weak, and also the major customer the orders from them might be flat. So we think it's still going to be a sluggish year, but the new customer will keep them upbeat. So the new customer is because they set up a new plant in Penang. Next slide. So next slide for Franken. So Franken is probably the best of the 3. The market was surprised because their earnings doubled quarter on quarter. So the market was excited about that. Mainly because of a jump. But do know that one of the reasons is that if you look at the second bullet point, they are one of the major customers put in a lot of orders. So because there's going to be a cut-off for exports to China. So a lot of orders will bottle up into the fourth quarter. Because they didn't want the orders to cross into 2024 because of the ban of exports to China. And then the major lithograph customer, so they got 3 new major customers. One is on the new product line, the major lithograph customer. The second one is a totally new front-end customer, Semiconductor. And then the third one is another customer shifting from Europe to Southeast Asia. But you might expect some short-term weakness under the outlook, but they are and also but they're going to get growth from all these 3 major customers. The other weak spot for them is hard disk drive. So in general, near term might be weak, but I think longer term is still very good because what is happening is that under the comment part, they're getting this big outsourcing shift from Europe and China to Southeast Asia. And because they spent more than 70 million capex the last 2 years, so that's why margins has been weak because they actually had to invest ahead. But when the recovery comes, I think the earnings growth is going to be quite spectacular for them. Next slide. Okay, I think we'll move on to.
Okay, thanks, Paul. There are a couple of questions here for semiconductor. So first question here is historically, how long does the semicon cycle last before it suffers oversupply? Do you think it will apply to the AI cycle? So usually it takes about 3 years, plus minus, to kind of go through the trough and then to the peak and then come back down. Do I think that this will apply to the AI cycle. I think maybe the AI cycle will drag this out a little bit more. Obviously, in the near term, you'll see this spike in demand. And then you probably start to see growth rates come down a bit, but to remain stable. So probably the back end will be a bit longer. And this is just because supply demand has been so strong in the early stages, and then it really right now has only really been benefiting uh, your processor companies like Nvidia and so on. It hasn't really flown into the rest of the semiconductor industry as so yeah. So my thoughts are this cycle might take a little bit longer just because of the transformation that's going, especially when it comes to PCs and data centers and so on. Another question. Hope that answers your question. There's another question here on what are your views on Nvidia and AMD? Both have run up a lot over the last 3 to 6 months. Yeah, so our views are that there's probably still a little bit more to run for these two companies. Obviously, demand is very strong, but when it comes to Nvidia, when they go into the second quarter of this year, the comparisons, second quarter and beyond, the comparisons will be quite tough because that's really when the AI boom kind of took off. So you'll start to see a lot of the growth rates come down significantly, the earnings as well come down significantly, but still fairly healthy. Like just you won't get your double or tripling kind of effect. For AMD, it's probably going to be a little bit slower, or rather a little bit different because they are earlier in the cycle. So for AMD, there's probably a little bit more room to run in terms of upside from their stock price. Also because GPU or data center GPUs only make up about 25 to 30% of their business. So they have a lot of other components, like PC and so on that have been in a downturn and been dragging them down, but we should start to see them pick up a little bit. So based on that, there should be a little bit more upside for AMD instead. Yeah, hope that helps. I'll pass it on to the rest of my colleagues. Thank you.
Hey, thanks, John. Yeah, maybe I'll just take some more. There are quite a few banking questions. Excuse me. Hold on. Let's try to find the first one. Okay, hi Glenn. Can OCBC continue to hold back on returning capital even though their CET1 is so high now? Yeah, that's a very good question, which is why we did forecast for FY23 the dividends will be higher, than what they actually gave out. So it was sort of below expectations for their dividends, and I think from the analyst briefing and from the media briefing, what they said was that they are going to maintain it at above 50%. So that is their baseline. They did not say much about whether they're going to give it back. I think they were quite apprehensive on saying even anything more. I think a lot of questions were targeted at their high capital, as well, as the sort of lackluster dividends, because DBS is willing to upfront say how much they're going to give, and what in the next few years as well. But OCBC will just say that we expect the income to grow, and with that, dividends will grow as well because they are keeping it at a minimum of, I think it's a minimum of base 50% dividend payout ratio. So we will just have to see. Maybe they'll do an acquisition. It's really very hard to say because the Indo one they did it with the PT Bank. Although it's small, but at least they did an acquisition, like compared to their peers who have really done their Citibank acquisitions. So it's a lot smaller compared to those two. But they also did some small acquisitions with the insurance side as well. Yeah. What's your ranking of the 3 local debt banks now after reporting the results? So if you look at the banks, I think going forward, there's also one more question I read, I think, about how will low interest rates affect the bank. So maybe I'll answer that as well. So you look at all 3 banks, I think they will be affected quite similarly. So I think UOB and OCBC, they were not as forthcoming with how they will maintain net interest income. But I think we just look at DBS because DBS, they did mention a bit more. So we just use DBS as a base case, right? So how do they expect for this year, how will the low interest rates affect them, and whether or not it will sort of maintain their net interest income? And I think net interest income, so the headwinds, will be sort of the CASA repricing. So CASA repricing will cost them quite a bit for their net interest income because they have to reprice their CASA due to the lower interest rate. So this will cost them a bit. And I think they also did say the interest rate sensitivity of their book will also, it will, as their book lowers, it gets repriced down, this will also cost them as well. So these are the two sort of headwinds, when it comes to a lower interest rate. But if you look at the tailwinds, like how will the tailwinds offset these headwinds? We look at their fixed rate assets. So these are assets, interest-bearing assets, so assets that get interest. So this will also be, they're looking to get it repriced and hopefully at a longer term. So this will give them a sort of an uplift to them for their net interest income. And I think also at least for DBS and UOB, they're also looking at their CTA acquisitions. And I think now for OCBC, we are also looking at their PT Bank, the PT Bank Commonwealth, which will also sort of impact them positively. Yep, and the last part, which will be their sort of treasury markets, their rates will improve when the rates go down. Yeah. So this, when you balance it all out, I think all three banks at least are looking at sort of flattish net interest income. And you look at so let's get back to the question, what's the ranking of the three local banks? I would think if you look at just based on the dividend yield and also the growth going into FY24, I think that would be DBS because they're very upfront about how much dividends they're paying out and what would be the yearly increment as well. I think the DBS is now the highest dividend yield. We're looking at around 7.2%. One more question. Oh yeah, so basically I just answered this question. No matter how much someone else looking at the banks, no matter how much the fee income grows, you'll never be able to offset the drop in interest income. So when interest rates drop in the future, banks will never be able to maintain the good incomes they're enjoying today, right? Yes, so I don't think we're looking at a drop in interest income, but maybe what you're referring to is the drop in the growth in interest income. So the interest income growth will not be like what we saw in FY23 or even FY22. So it'll be rather flat, but fee income will come in just to boost their earnings. So this will, of course, improve their bottom line. Okay, someone asked, what's your take on the minority shareholders of GE who propose resolutions in relation to, I think you meant OCBC, not UOB. Yeah, so just a brief background on what happened. I think this was only this morning. So the GE minority shareholders just came out to say that they want to get better understanding of why the shares are undervalued, and also to bring in a second, I think it's a financial, like to get a fair valuation of the company. Yeah, so I don't think there's anything we can really say now because we don't know what is the outcome of this yet. Yeah, I think there's also one more question regarding, so the next one, OCBC is holding 88% of shares of Great Eastern Holding. What are the possible pros and cons if OCBC is to privatize Great Eastern, as it is currently trading at a significant discount to its embedded value? Yeah, of course, there are a few pros and cons to this. The pros, I think for the pros wise, it would give OCBC full control over Great Eastern's operations as well as their sort of strategic direction, and it will maybe be able to help them synergize the company better, right? So also, as you said, it is trading at a significant discount to its embedded value. So, if they were to privatize it, they could potentially gain from this increased value if it's privatized. And the cons, I would say there will be a cost. So it would require OCBC to buy out the remaining shares, and this could come at a sort of quite a significant cost to them. And the market's reaction as well. What will people say? If they do buy Great Eastern? Okay, I think I answered this question. The view of SG banks on the current interest expectation. Well, what's a good price to buy DBS now? So if you look at our current, we have a report out. I think I spoke about it maybe 2 weeks ago. Yep. So we're looking at our target price is currently $38.90. So I think you can read the report as well, and then you can just sort of get an understanding. I can't really say what is a good price. I think that's it. Yeah. Yeah, I'll hand it over to the rest of my colleagues first while I wait for the other questions to come in.
Yeah. Okay. Thanks, Glenn. Yes, so I'll answer just some questions now. Please can you comment on UL CityDev, CLI results and analyst call post results? Yeah, so basically, all three of these property companies, they were affected by high interest rates, and all three also saw a good rebound in the hospitality sector. So the performance in the hospitality sector, like for CLI, just like I mentioned during the slides, their management fees increased by over 20%, and they also benefited from the ownership stake. So for ownership stake, UL and CTF also benefit from the hospitality sector, the hospitality improvement, like the improvement in RevPAR. So we saw across the board double-digit improvement for all three property companies. So I won't talk too much about CLI because I already went through it just now. But first for UOL, they had a gain of about 400 million from the divestment of Park Royal Kitchener. So that really helped to boost the bottom line. But if you strip that out, the year-on-year decline in PATMI was about 25%. So for CityDev, this quarter they had or rather for FY23, they recognize Piedmont grants because it's an EC, so they recognize the full revenue contribution and the earnings from Piedmont grant. So as a result, we saw that the revenue was at a record high, like close to 5 million. The year before was about 3 billion. So yeah, and regarding the property development outlook, we saw that the demand for the new launches were quite lackluster. So back then in remember 2022, within all the new launches sold out like 100% within the launch weekend. But now we see that most of the launches like around 50%. So like CDL, they came out and said in the Mist, for example, is about 50% sold. And in the first quarter this year, they also had the launch of a Luminar Grand EC, which is also around 50% sold. So the demand is quite lackluster, and we still think they're impacted by the higher ABSD. Yeah. So yeah, and CityDev, they also came out and said that they have a 1 billion divestment target this year. So that's trying to follow in CLI footsteps where they do some asset recycling to reposition their assets into higher yielding asset classes and such. Yeah, so I guess that's my comment for all three. I'll move to the next question. Hi, then what's the percentage impact to retail and hospitality REITs, MPI and DPU from first quarter Taylor Swift in our view? Yeah, okay, so first of all, for hospitality REITs, they are more of the direct beneficiary from Taylor Swift, mainly because if all this travel from people who travel here to Singapore just to watch Taylor Swift, they will definitely need a hotel room to stay. So we know that the hotel room rates are already like 30% or even higher from an average week where there are no events happening. So from that perspective, we already know RevPAR is higher. And because of that, the variable component in a lot of these REITs will have higher contribution because of the increase in RevPAR will trickle down into this variable component. So as a result, we think MPI likely to increase by double digit or even maybe 20%, and DPU also around the 10% mark. So that is for mainly for MPI and DPU for hospitality REITs. We still think, especially like the strong lineup in events, especially in this first quarter, RevPAR, like we also saw in Paul's slides earlier, the RevPAR in January rebounded from a negative year-on-year growth in December to about 13%, but the January one was mainly because of Coldplay in the last 2 weeks. Yeah, during Coldplay's concert, we also saw RevPAR up by about 20% as compared to the usual like in the usual week where there are no events happening. So that's the MPI for hospitality. For retail, it's more of not a direct beneficiary, it's more like an indirect beneficiary. So MPI and DPU, likely might not be that much positive impact on these retail REITs, especially since a lot of these tourists, they come to Singapore just to watch Taylor Swift and not to shop. Maybe we see some F&B spending and such, but definitely not unlikely is luxury products. So yeah, tenant sales likely to just increase, like maybe in the F&B side, maybe like not so much luxury like I mentioned. So NPI and DPU likely to be that much affected from this specific few weeks that Taylor Swift is here. Yeah, I hope that answers the question for this NPI and DPU impact in first quarter.
Yeah,
but we
sorry to interrupt you there. So just to give you all a flavor, so when Coldplay happened, what the hotel says is that all the rooms are you can't find a room, everything is all booked. Then the occupancy will jump from 80 to 90%, and then the rates will jump probably 5 to 10%. Just to give you a flavor, like what Darren mentioned. But basically, and you can imagine that's Coldplay, so Taylor Swift, probably everything is all booked out. Yeah, sorry, Darren, go ahead.
Yeah. Thanks for that part. Yeah, and to add on also, Coldplay, they had concerts everywhere in Southeast Asia, like Singapore, Malaysia, Jakarta, Bali, all this. Yeah, so basically Southeast Asia, they had a lot of concerts before coming to Singapore. So because of that, the number of tourists coming to Singapore just for Coldplay is definitely lower than Taylor Swift, where Taylor Swift has this, like you see in the recent news, this exclusivity contract that Singapore had. I don't talk about politics, but yeah, they paid some fee apparently. So yeah, so definitely the tourism will be way more for Taylor Swift. Yeah, so all in all, third quarter, we think RevPAR, despite a higher base in FY23 for the first quarter, definitely RevPAR will be up at least 15% in my view for first quarter. Oh yeah, how much RevPAR expected to rocket in quarter one for Taylor Swift? Yeah, for the RevPAR minimum, definitely at least 30% for the week that Taylor Swift is here, but overall, probably about 15%, accounting for like the Singapore Air Show, Coldplay, Ed Sheeran, Taylor Swift. So this first quarter was really very little downtime in events. Yeah, so RevPAR definitely very solid. What's the reason for Ashby's poor performance last week? Recent inflation data in US and Singapore are not too bad. Yeah, I think this is mainly because of the expectations of interest rates. Like Paul mentioned he had one slide where the expectations are no longer 5 rate cuts and probably just 3 rate cuts. So the movements in the interest rate expectations really will affect the S-REIT share price. So because of these movements, recently we've seen S-REITs, the share price is quite volatile. Yeah. Okay, further to your presentation on CLI, can you give your view on what would the impact of the future of CapitaLand China Trust? So CapitaLand China Trust, the outlook is mainly for their logistic assets is quite bad because there's a lot of consolidation in the e-commerce players. Like back then in COVID, all these e-commerce players, they really expanded like multi-fold. The Alibaba, JD, all these, their logistic, they really expanded way too much. So now there's a lot of consolidation among them, and as a result, the demand for these logistic assets are much lower. So we've seen in their portfolio, the logistics occupancy fell to about 80% from 90% in the previous year. So we still think there's the demand is not there. So occupancy likely to drop and negative, and we also expect negative rental reversions for especially the logistics side. But for retail, likely to pick up as we've seen tenant sales and shopper traffic increase by about 40% year on year in China. Yeah. Eh, mm, uh, Taylor Swift concert surrounding got quite a few hotel. Do you know what's the impact? This one can't really comment, but basically like we expect that like Paul mentioned, even the Coldplay concert, we saw hotel occupancy 90% full. Like it's very hard to get a room. Like Taylor Swift probably whatever class of hotel, like upscale luxury, mid tier, also we expect it to be relatively full, like above the 90%. Which property company has a divestment target 1 billion? Yeah, that is a city developments. Yeah, I think I will hand the rest of the time to my colleagues for now.
Thanks, Darren. I'll take over
Yeah,
from
thanks.
here. Okay, there's a question for me. China Aviation Oil share price went the reverse way after posting good results. Okay, I think generally the market was expecting them to deliver higher dividend, even much higher than what they announced. So what they had given out is only amounting to 5.4% a yield. Given that they have a net cash of $373 million in the books, that is about like 62.3 cents Singapore cents per share. But yeah, I think the dividend the market was expecting higher, but because this cash in the books are actually required for the trading activities, so we have not in our forecast included any of a much higher pump up in the dividend from CAO. But still, the 5.4% we felt was quite decent compared to the current FD rates. Yeah. Thank you. The second question for me. Hi, Peggy. Based on what you can see now, is SATS acquisition of WFS a good move? Well, okay, even think let's see it this way. If they don't have if they didn't buy WFS, the core business of SATS would probably still be as what they have performed up to 9 months this year. The industry has not returned back to the pre-COVID type of situation. And on top of that, they enjoyed a good COVID run during when they were transporting the vaccines for us. So WFS, the contribution is small right now, but still is at least a positive contribution. The second reason why they wanted WFS was that the SATS former the SATS only business, about 80% of that derived from the Singapore market, which is very, very concentrated. So with WFS, at least they reach out to the global markets with US and Europe contributing like 75% of the total pie now. So I think there's a reason for them in terms of strategically to move out beyond the Singapore, beyond Asia. As the SATS tradition business is really very it's almost like a controlled market per se, because when you want to get into a new country, you really need the blessings of the local joint venture partners to get through. It's this aviation sector is very how we put it, the territorial kind of business. So I think that's probably the reason why SATS that pushed SATS to look further out, to look at other business that could be synergistic and widen and open up the more markets for them. Yeah. So wouldn't say is a good or a bad move. I think strategically is still quite important to them. Thanks. There's one question on as Semiconductor industry has dropped a fair bit for 2 weeks. Any comments and any latest review? Thanks. I think this is in line with the interest rates view. As SCI has not been the yield from SCI has not been great. It's about 2%. They are still growing their renewable business, the portfolio. So still continue to be investing in an investing mode for growth. But the market also tends to treat them as a as income stocks because of their 80% exposure to the local energy market. So in terms of when the interest rate is up, the SCI's price will react to it, as the yield has not been matching up to the required yield that the market is looking for. That's why I think that it's affecting the share price. Yeah. Can you give your view on SIA? Okay, Changi Airport's traffic volume continue to grow, but SIA says the growth rate in terms of the monthly revenue, monthly volume numbers that we see is slightly lower than what Changi Airport is reporting. So to us, that means that more other non-SIA flights are coming into the space. And we also see the yield is measured by revenue per available seat kilometer. We also see we call it Raffles for short, declining in the latest quarter, third quarter. And if the competing airlines were to come in and launch a lot more capacity, you find the load factors overall might be lower than what they are enjoying right now. And when you have empty seats, your Raffles, your yield will fall much fast at a much faster rate. So therefore we feel that and Raffles effect translate immediately to the revenue and your bottom line, because your costs whether it's a seat that's filled or it's empty, there's a fixed cost is still there that you need to incur. So for us, we feel that for SIA, the growth momentum from here might be slower as they find the competing pressures coming through from the other airlines more intense. And the jet fuel prices year to date is already up about 9%. So there's another cost item that is going to rise for them as well. So and of course, lingering thought is that SIA wants to use deploy 5% of the fuel consumption, want to deploy the sustainable aviation fuel to account for 5% of the fuel consumption. They have to think of how to pass on this higher cost of this SAF to the customers. So far, the local traffic authority has approved a 1% increase, 1% use of this SAF, and the higher pass on a higher levy to the airline passengers, but SIA wants to go 5%. So how do they deal with the other 4% increase in their cost? It's something that they might have to figure out. Yeah. So all in there's no growth angle to look at for SIA. The immediate boost, which you read in a lot of other analyst reports, is that the merger of Tata, of Air India and Vistara, and that will mean that they write back 1.2 billion into their balance sheet. So with that they recognize a gain, but this is really accounting entry. Yeah, overall, it's operating wise, it will not have an impact on their cash flow or except for the amount of additional investment they have to put into this joint venture. Thanks. That's what I have for SIA. Thank you. I think I pass back to the rest. Thank you very much.
Thank you, Peggy. And there's one question for me. So, hi Amrish, do you see continued uplift from Cash App continue as Bitcoin is in super bull run this year? So yes, we do expect the Bitcoin revenue to surge this year by about 12% or so. Just as to note that last year it grew by about 40 plus percentage, and it was mainly because there was a crash in 2022 in the Bitcoin prices, and as a result, their Bitcoin revenues had dropped significantly. But for this year, at least we expect the revenue to grow, Bitcoin revenue to grow by about 12%. But I mean, due to tough comparisons, not as significant as the previous year. And just as a side note, the Bitcoin revenue for the Cash App business, it's basically just a pass-through business for Block. And so basically, it purchases the bitcoins that the users place an order. It purchases those bitcoins from the third party agents and then sell it to the customer. So as a result, it's a low margin business for the company Block, and it generates a low margin business like about 2 to 3% range. So so basically company looks at it at its consolidated gross profit for Cash App and not just the Bitcoin revenue. So that's all for me. I would now like to pass on to the rest of the team.
Yeah, okay, thanks. I'll try and just do a few before I pass it on to Zain. Please comment on EM's results. I think we probably done that. Sorry. Harpo, do you think the recent announcement of 100 million investment to upgrade the NBN will benefit NetLink Trust in any way? Yeah, I saw the announcement too. Thanks for the question, Mr. Ang. So what has happened is that actually it's already in the latest rates. So there's already into the forecast. So it benefits them, but very indirect. They're building a new central office in Seletar so that they can boost the so-called 10 gigabyte of data, yeah, for the whole Singapore. But there is big in. So how this works is that they will go to the authorities and let's say that you want to spend, so the authorities will give them this budget to spend and allow them to earn a return on it. Then this will translate into how high they can charge the clients. So without that, maybe the rates that, recently the 1380 was dropped. What was the latest number? The 1380 per month they collect from all the telcos. So that was dropped recently, and that is even including this. So this is already part of it in the discussion. So what happens that 100 million they will spend for all this will be plot back through the higher rates, the rates that they charge. High PropNex estimates are a lot more bullish versus ERA. Is it? Yeah, actually that's my mistake. Actually, thanks for highlighting it. Actually, for new home sales, was 9 to 17 for PropNex. For ERA is like 12 to 29. So actually they are more bullish. So the range is between 7,000 to 8,000. Which isn't that high because it's back to the, like you mentioned earlier, the TDSR level about 7 to 8,000 units. During the most lull period. So it was actually a typo by me. Yeah, sorry for that. Yeah. High Cities report mentioned their view is Siong, even if have new stores, is unable to generate meaningful revenue. I think if you get new stores, you will definitely generate revenue. But you cannot. But 3 stores is not enough. So they got 60 plus stores. They need to hit at least 6 stores. Their target is minimum 3 stores. So they got 60 plus. So you need to hit. I mean, mathematically, right? I mean, you need to hit like at least 5 stores. Then you can generate growth. Because there was a lull the last 2 years. Last 2 years they need to open, I think, 3 stores or 4 stores over 2 years. So this is going to be reflected in this year's revenue. It won't be that strong. But do note that they already secured 2 new stores this year. I'm confused everyone. But anyway, they secured 2 new stores in 2024 and they're bidding for another 10. So this we think is still a temporary temporary lull. And it could actually recover the following year. Just that we think that with the valuations in high teens and limited growth, at least for this year, it's going to be hard to push the stock. What is Sirius 3 line in your 50 basis point? Sorry, can someone show the chart? Yeah, sorry, I can't. How about venture? Any new target price? Yeah. So these are mainly the semiconductor, nothing to do with venture. So like AEM, UMS, their clients may or may not be, could be like Applied Materials, ASML, UMS. So venture has some semicon, but it's nowhere near some of these the three companies that I mentioned, Franken, Semicon can be at least 50, 60 to even as much as 90% of their revenue. Venture, we think probably 10, 20%. So it's about the degree. So venture may do some, but it's actually quite small. Oh, Series C, oh, sorry, yeah. Well, Series C, sorry, it's actually February. Yeah, thanks for spotting that. Yeah, my error again. So Series C is actually the February. So you look at here. So December, this is where people, the futures market thing, where interest rates are going to be. Then there's January. So not much movement, no, December to January. But February, you could see it just spiked up. So it's the green line is actually February. So a lot of slides to do, so might miss out. Yeah, thanks for highlighting it. Yeah. What's your view on TLT and EF? So TLT is basically the long bonds. I think I think it's going to be a bit stuck. I think unless you see some dramatic slowdown in the US, which with the election year this year, I think everything could actually be pushed out into 2025. So yeah, I'm not sure what's IEF. Sorry. Do you have a target price for? Yeah, I think all this John can answer. Yeah, can you comment on Singtel? So Singtel, we are still positive on Singtel. Because we think there's a mobile price recovery and they're also going to sell a lot of non-core assets. Any reason for the sell down? I'm not sure. I don't really cover. CDR, I'll leave it to Darren. C, I'll leave it to John. Yeah. Okay, I think the rest can take over. Then we pan into Zane. Yeah. Do one quick on our Paul and team. What's your overall outlook on Singapore? Your view on STI ETF? Yeah, I think it's going to be very sideways driven. Even like you said, from the banks to the REITs to the property, none of the sectors are actually have any strong growth. The only two sectors that have strong growth is actually anything tourism related, travel related, and of course electronics, but skewed towards semiconductors. So with this thing, I think it's still going to be sideways movement for Singapore market. But the dividend yield will hold these stocks. I mean, like banks are all trading 7% yield. So we'll just move sideways. Of course, there's a dividend yield support, but not much growth for this year. Okay, thanks. Sorry, John, go ahead.
Yeah, thanks, Paul. Yeah, so there's this question: do you have a target price for AMD, ARM, and Nvidia? Yeah, so for AMD, we have an accumulate rating with a target price of 195 US dollars. And then for Nvidia, we've got buy at 970 US dollars. We don't actually cover, we don't have a rating on ARM yet. Yeah. So that's from a fundamental standpoint, those are our target prices for AMD. And this is another question: does your team expect positive earnings for C? Do you have an estimated target price? Yeah, so I believe for C, let me check this real quick. Well, for earnings, we think we're quite neutral actually, because for for C, they still have a lot of headwinds from or rather they have been having a lot of headwinds from their digital entertainment business, which is Garena. A lot of users have been dropping off, although this trend is starting to come back a bit. But overall, it's really all about how well they can monetize their e-commerce business, which is Shopee, since that's really the main revenue driver. And so one thing about e-commerce is that competition is very difficult. There's a lot of players in not just in the region but globally as well. And then especially as Shopee operates in a lot of the lower monetization areas, like Southeast Asia and Latin America, it's a little bit more of a headwind compared to people like Amazon that have basically monopolies in the US and so we're looking towards their earnings. We're a bit lukewarm. I think it'll still be unless something really stands out, like Garena users start shooting back again, shooting up again, and e-commerce GMV starting to grow and reaccelerate again. We do think that in the near term they still have these kind of a lot of uncertainties, especially as they grapple with being profitable on the bottom line without spending too much money. Yeah, sorry, I'm trying to find the target price here. I believe we have a buy rating. I believe it's at, sorry. believe it's at sorry, hold on. Yes, we have a buy at $61. So I hope that helps. I'll pass it on to, I think, Zane for now.
Yeah, maybe one quick question. What do you think CDL will divest? So it could be some hospitality assets that they'll divest to the sister REIT, CDL Hospitality Trust, and they also previously they had plans to list a UK commercial REIT, so that might happen as well. If market conditions become better. But one thing to know is that CDL they hold all these assets at cost. So when they do divest, it's likely they'll recognize some significant divestment gains. Yeah, I think that's all. I'll hand over to Zane. Yeah, Zane, thanks.
Thanks, Aaron. I'll move on to the TA. Yeah, so first up is on Seatrium. I think currently we're likely to see some sideways price action. Price has actually retested the lows of 0.086 after the results. There was a break above the moving averages on last Friday. So I think we will still hold at 0.091 with some near-term resistance at 0.096. So likely some consolidation for the time being. Then for next one is our Mapletree Logistics. For this is still quite still remaining quite strong in the downtrend. Recently there was a breakdown below 148 level. Moving average still suppressing the price with resistance. So for now I would expect a little bit more downside, possibly a retest of 141 swing lows over here before there's some respite in terms of this downtrend we started in end December last year. Okay, then next one is Parkway Life. Okay, for Parkway Life, I think it's in a volatile uptrend. So over here, we have actually in this stretch over here since November, we actually seen higher highs as well as higher lows being formed. Currently, I think we're still pulling back, but I think we'll form a higher low as compared to the low seen in 335 in end January. So I believe support will come in around 345 to 350 area, then the share price might do a bit of bounce. But for now, there's no confirmation signals yet. Okay, next one is on Broadcom. Okay, for Broadcom, I think it's still quite bullish. Price actually had a breakout on Friday. So a consolidation period over here around 1,002 to 1,003. So if that if it actually goes higher, it could actually retest this trendline resistance over here, which could bring the price close to 1,005. It actually continues the strong momentum. So remaining bullish on Broadcom. The next one is on Amazon. Okay, Amazon also I think is looking better after a sideways movement. Price has started to break above this 175 level over here. So I'm remaining bullish on Amazon. It could go to the next higher resistance level, which is around close to 185 to 188 as the next key resistances. Okay, then the next one is on Google. Okay, for Google, I still remain bearish on it. Price is actually what I did recently was retest of the rising wedge breakdown and price trended lower, currently holding at $136 support over here. However, if this breaks down, I think we could see price, we're likely to see price trend lower towards 129, 130 level here to actually continue the current bearish momentum. Yeah, so still remaining bearish on Google. Next one is on SATS. Okay, for SATS, I think currently is trading in this downtrend channel here. Let me highlight it in blue. Yeah, so currently still trading is downtrend channel. Recently, finding resistance at 270 prior support breakdown. So I will expect SATS to just trade sideways between 260 to 270 for now, with a still bearish bias. It's still currently trending downwards. And next one is on Franken. Yeah, Franken is still very strong. Strong price action recently. After the earnings release, we see it making new highs above 160. Currently it's at 168. So at 169, it was a previous 169 to 172 as prior swing high level. It could see a bit of a pause in the rally over here with some consolidation movement. But I'm still bullish on in this uptrend to actually create higher highs in midterm. So some consolidation action first, but likely to create new highs thereafter. Okay, then as for AEM, currently still bearish. There was a sell down with high volume recently after the results, below the 141 level currently as well. So I think we could see some sideways movement with support coming in at 133, 134. Then price will actually just continue consolidate sideways for the time being. Then as for AEM, price found support at a 210 level with a prior horizontal resistance acting as support, but I think currently it's doing what it probably do with a big gap bounce towards a retest of 5-day moving average. Then we might see turn down again, as it's currently still seeing very weak price action. Okay, next one is on SMIC, which is Semiconductor Manufacturing International. Yep. So for SMIC, I think I'm remaining more bullish on this. Recently, price has broken out this downtrend resistance line over here. Also, we are starting to see higher highs clearing out this 1640 resistance level. So price is currently just consolidating over here. I think we're likely to see price continue to hit higher towards $18 to $19 as the next key resistance, as it's likely to trend higher gradually. And next one is on Celestica CLS. On Celestica, I think very strong uptrend over here. Recently broke above this trend line resistance. Currently it's around $45. The next key resistance will be around 47. Yeah, based on the weekly levels, this was back in 2001. So we might experience a bit of a consolidation action there after it hits this level. And for next one is Corning GLW. Corning, I think is still quite bullish, still trading in this main ascending broadening wedge. Recent price action finding support at 31, 32. This convergence of supports and rebounding over here. So I expect price to actually rebound further to retest the 3350 level, then followed by afterwards make new highs towards. I make higher highs towards the retest of the 35 resistance over here. Yeah. So next one is a Far East Hospitality Trust. And for Far East, I think price is still quite muted. It's just been range trading between 60 cents to 63. But there's a bit of a bearish bias in the near term to actually trade lower. I've seen weak momentum coming down, and price is forming currently below the MAs as well. So I think we could see a slight greater pullback towards 58 cents or 59 cents for Far East Hospitality. Okay, then for Mapletree Pan Asia Commercial, also broke below 136 support level recently. So we are likely to see price retest the 129 level, quite close around there. Then we might see some slight consolidative action, but still bearish bias towards a retest of the lows around 124 over here, as we are still in quite a strong downtrend, similar to Mapletree Logistics chart earlier. The next one is Asian Pay TV. Actually, Asian Pay TV currently price just range bound 0.084 to 0.089. So I think that will still likely just trade in this range for the time being. Nothing too much. Okay, next one is on CDL Hospitality Trust. Okay, so CDL Hospitality price action is still breaking new lows recently. and also lower highs. So I think that will still continue for time being towards a retest of the swing low over here at around 92 cents. And CapitaLand Escort did a retest of the lows over here at 90 cents. Price action is still rather weak for now, was unable to rebound after 3 days. I think still quite weak. Likely to see lower high rebound with resistance around 91.5 cents, 92 cents. Could trend a bit lower towards 87, 88 cents for time being for CLAS. The next one is the Starhill Global REIT. Okay, for Starhill, I think it's still trending downwards for now. Lower highs, lower lows, also along this downtrend resistance line. So I'm expecting to actually retest support level at 46.5 cents before there's some sideways movement. Okay, then next one is for city developments. Okay, city developments is still quite weak price action over here, seeing new lows. So I think we are likely to retest around 558 as a support level previously. Then perhaps you could see some sideways afterwards. Okay, then next up is PropNex. Okay, PropNex also broke down support 90 cents recently, forming lower highs, lower lows over here, resisted along this downtrend resistance line. For now, could see some sideways action. Previously, 86 cents was a prior resistance level. Now I think it's support. So I expect some sideways between 86 to 90 cents for now. Okay, the next one is on CapitaLand China Trust. Yeah, it's still quite weak price action over here. We tested the swing low over here at 74 cents, but looks like we weren't able to see a very strong rebound. So there is still quite a possibility that price continue to trend lower towards the next support level close to 71 cents. Yeah, the downtrend over here is still quite strong. And then next up is Baba Hong Kong. Okay, for Baba Hong Kong, generally still quite range bound over here. But some positives is that we are seeing a higher lows being formed perhaps along this downtrend resistance line. So we are able to see price support around 7150 and do a rebound. And I think it's still more positive that in the midterm there is a possibility of a breakout above 76. Yeah, but for now it's still some consolidative action. And next up for Tesla. Tesla I think is still just range trading, but still getting resistance at the prior support level around 207. It could be trading in this blue color rising wedge, bearish flag over here. Yeah, but I think for now it still likely just remains range bound between this 198 to 207 range. Okay, then next up is Palantir. For Palantir, I think just doing a consolidation. Resistance still holding on the highs at 2550, but we're seeing higher lows being formed, potential ascending triangle. So I'm still more bullish for this counter for a breakout in the near term or mid term. Okay, then for Genting, seeing some price started to sideways a little, and finding support at the 88 cents level over there. I think we are likely to see some modest rebound and some sideways with some resistance around 93, 94 cents level. Yeah, given the strong sell down over here, so it's probably just a bounce and sideways after. Okay, next one is Samudra Shipping. Okay, for Samudra, quite range bound. Resistance still holding at 74 cents. Positive is that higher low being formed. Over here we have 68 cents, then 69. So if you continue to see higher lows over here, then I think it's a positive. But for now, it's just just range bound around 71 to 74 cents. Okay, then next up is Delphi. Okay, Delphi, I think the price action wise is quite weak. It's breaking down of the main downtrend channel. Just highlight it in bold. Yeah, so for now this is quite weak. Also broke down below the $1 support level previously back in March last year. So I think I'm more bearish for the price to actually trade lower. To actually, there's a possibility of the gap fill at around 89 cents to 92 cents over here. As over here, there's a volume imbalance and price could actually go down given the weak price action we are seeing currently. Okay, then next one is JD Hong Kong. Okay, for JD Hong Kong, I think it's building an ascending triangle over here, resistance at around 95, but we are seeing higher lows. So if this continues to hold, then I think more positive for an ascending triangle breakout in near to mid-term. Yeah. Okay, then next one, 986 Xpeng. Okay, for Xpeng, I think still range bound over here. Resistance at 38.50 around there. So I think that will still probably consolidate with support at this 34 level. And next one is on Thai Bev. Okay, for Thai Bev, I think nothing too much. We're still seeing a very, very range pattern, 49 cents to 53 cents. And I think still holding around there. So we are quite near the support, 49 cents. I think we'll still continue to hold and just trade in this range pattern. Okay, next one is Best World. Okay, for Best World, I think still quite range as well. A broader range recently rebounded from 163 support. Also clearing above this 168 level as well. So we'll see some further rebound towards 176, 177 before some resistance. Then I think some sideways consolidation thereafter. Okay, then what's my view on Intel? First, I give a TA view. Okay, for Intel, TA wise, nothing too much. It's just quite sideways in this range, 42 to about $45. So I think that will still continue for now. Okay, for SMCI. Okay, SMCI TA, let's see. Okay, I think for SMCI, I'm more bullish. Very strong run, then price has started to consolidate in this pattern over here. Also, think there will be a gap up as it's included S&P. Yeah, so I think we are likely to see price continue its bullish run. Yeah, I think we'll likely see price retest these highs near 1080 in the short term. Okay, then next one is Aztec. Okay, Aztec, I think I'm also bullish on Aztec. Today we saw a new recent high above the 99 cents level. So I think price is likely to continue to trend higher. Look at the weekly chart, the next key resistance is at $1.02, then followed by $1.05. Yeah. I think likely to see price continue its bullish trend. Next one is Grand Venture. Okay, for Grand Venture, currently is at a support level, but this might be less reliable due to the low volume for this counter. So I think for now, it's likely to do a bit of sideways, 46 cents to about 50 cents over here. Yeah. And Fortress Minerals. Yeah, Fortress Minerals, I can't really comment too much. There's really too little volume for this, but overall, the big picture wise is just a long-term downtrend over here with some support. Yeah, with some support recently around 26 cents level and resistance at a 30 cents level over there. Okay, next one is Capital DC REIT. Okay, for KDC, I think it's likely to resume its very downwards price action over here. We seeing lower highs being created, and then recently we see price cut through the MA supports as well. So I'm more bearish towards a retest of 163 support again for KDC in the near term. Okay, then ST Engineering. Yeah, ST Engineering is quite strong. So recently price broke above this 390 resistance. Then some sideways action for now. So I think we'll just consolidate around this 390 to about $4 range. Okay, next one is on Venture. Okay, Venture I think is still holding well in this main uptrend channel over here. So I would expect it continue to trend higher to actually retest around 1460, 1470, which was a price swing high over here. Next one is Semiconductors Industries. Okay, for Semiconductors, still weak price action. Looks like it's still finding resistance at the 5-day moving average over here. So we could still see price trend out a little bit lower towards the support at around 480 to 490 over here. Okay, then I think the last one is on Serial Systems. Yeah, for this quarter also not much volume. Yeah, so this T might be less accurate for this counter, but overall wise, still downward trending in this stretch. Yeah, so I would think that it might come down to test a support 0.043 about there, given it was a prior low back during the COVID lows in 2020 as well. Yeah, so still quite downtrend. Yeah, so I think that's all for the TA. I'll hand on time to my colleagues if they have more remarks to add on. Thanks.
Yeah, okay, thanks. I think we did cross the 1 p.m. So thanks everyone. I know there's still some questions, so sorry for that. We try to stop by 1 because it's already 2 hours. But if you have any questions, feel free to go into our Poems Tree community app and just post any questions and we'll try to answer them as soon as we can. Yeah. With that, I'd like to thank everyone for your time and also have a good week and prosperous week and healthy week ahead. Thank you, everybody. Thank you. Bye-bye.